Hello, neighbors, and welcome back to the neighborhood, or welcome to the neighborhood for your very first time. I am Squealer D, and I am back again. And this time, neighbors, we are back in the financial world. Day two. Yeah, we are learning about the stock market, guys. We're going to go through everything on this channel that I think I want to learn to begin investing my money into the stock market. I intentionally initially I thought that my intention was to be a day trader, but now I regressed and I am ready to say that I don't know what part of the stock market I will be engrossed in come the end of this, but I definitely need to know more about it. So yesterday, if you want to go back to the first video, what is the stock market? We go through the beginning of Investopedia's What is a Stock Market? A set of exchanges and other venues where shares of publicly held companies are bought and sold. So what I'm going to do is I'm going to go through this daily so you can start at day one and go through and pretty much just learn what I'm learning as I'm learning it. That gives you a chance to go back or go forward or skip things that you are not interested in. Yesterday, like I said, we talked about what is the stock market and what is a stock or a unit of equity in a company. Today, we are talking about what is a stock versus what is a bond, because those words are usually found together in sentences like, oh, I invest in stocks and bonds. So we will be looking at what is the difference. And I also had given myself homework to find out with the Buttonwood Agreement who were the signers. It had 24 signers in the Buttonwood Agreement. We're going to start with that today because that goes back to the beginning of the stock market, which was kind of yesterday. So let's finish that up. So the Buttonwood Agreement was a written compact made in 1792 between 24 stockbrokers and merchants on Wall Street in New York City, rumored to have been created under a buttonwood tree, hence the name. The agreement marked the origin of an official stock exchange for the young United States and the beginning of an American investment community that would become known as Wall Street. And stockbrokers, for those of you that don't know, a stockbroker is a financial professional who execute orders in the market on behalf of clients. So when I say I want to get into the stock market, I do not want to be a stockbroker. We can cross it off my list. I know I don't want to do that. Most stockbrokers work for a brokerage firm and handle transactions for a number of individual and institutional customers. I just want to do my own type of trades for my own type of economic freedom. I don't want to work for a company and do any financial professional stockbroking market things. That's a definite, guys. I know that. Whew. Cross one off the list. Okay, so let's understand the Buttonwood Agreement. The Buttonwood Agreement came about in response to the financial panic of 1792, an intense 2-month period precipitated by a liberal loan policy on the part of the new Bank of the United States, as well as attempts by unscrupulous speculators to corner the debt securities market. When they failed, defaulting on their loans, it caused a run on the banks and a panic selling of securities. And securities, guys, are shares, remember? So the Buttonwood Agreement came in response to a financial panic. And that financial panic was in 1792, guys. We had another financial panic that we know about called the Great Depression. We had another financial panic that we know about called, 2008? I don't actually know what that one's called. But the crash of 2008, financial panic. The same things happened. A liberal loan policy gave out too many loans. People couldn't afford the loans they were giving. They used tricky loan, they have regulations on the loans, but they use tricks to get people into loans that they can't afford. And then like that, they default on their loans, they take the houses back and they resell them, doubling their their profit and leaving the normal person who paid for their rent or their mortgage every month, leaving them homeless. So we've seen that going on. I've seen it in my lifetime now. How many times? I wasn't here for the Great Depression. I was here for 2008. We went through a big financial change from the 80s to the 90s. I haven't been doing enough investigating into this type of stuff to tell you guys exactly the dates or the names of all of it, but I know that in my life we have seen several of these type of panics. So, what did they do in 1792? By extending credit and cash to local banks, Secretary of the Treasury Alexander Hamilton, great, great, great musical. If you guys haven't seen Hamilton, grab it, sing along, it's great. Managed to contain the crisis by May. So this dude, Alexander Hamilton, took control and he solved it by May, so 2 months. But the young U.S. and its financial system had been badly rattled, and many in the investment community felt that there was need to reestablish trust in the marketplace and to safeguard investors' interests. So it sounds like the rich people said, hey guys, you fix that up, but we need safeguards for us. This is our money. To that end, 24 merchants and brokers, the creme de la creme of the New York business financial community, so that means the creme de la creme, I'm guessing, means 24 of the richest people in New York. On paper, they had the most money. They came together and they said, hey guys, we need to put a stop loss and not lose this much money because it's kind of ridiculous. So they gathered on May 17th, 1792. Reputedly at what's now 68 Wall Street, under the shade of a buttonwood, aka a sycamore tree, to sign a written agreement they'd been discussing since March. Basically, they formed a club, agreeing to trade directly and exclusively with each other under some common rules and boundaries. But by closing the system against outside agents and auctioneers who had often conducted bond auctions and stock trades up to now, the participants would be assured that they could trust each other, that payments would be honored, and investments were legitimate bread. Hello, friends. Sit back and enjoy the show. We are learning about the Buttonwood Agreement. Very interesting stuff from 1792. So they made a deal that their trades would be legitimate and that their clients could have confidence as well. It also meant these brokers wouldn't try to undercut each other with lower commissions. It's profitable to be in this club, so you're going to follow the rules because you want to remain in the club. As economic historian Robert E. Wright characterized the pack, when you all know each other, why screw each other? So the rich people got together, made a club, said, we're not going to screw each other. We're not going to screw our clients. We're going to be cool so that we can keep making money. So the basic principles of the Buttonwood based their securities trading parameters on existing European trading systems at the time. In fact, the Spanish practice of dividing the silver dollar into eighths was largely responsible for the prevalence of fractions when describing stock values. The agreement itself was short, 2 sentences, with 2 provisions. The brokers were to deal only with each other. They would charge clients commissions on their trades at a set rate of 0.25% per transaction. In other words, they wouldn't have to be worrying about selling bad stock or competition over commission rates, so the prices charged would reflect the value of the stock, not some other factor. So, the exact text of the Buttonwood Agreement reads, we, the subscribers, brokers for the purchase and the sale of public stock, do hereby solemnly promise and pledge ourselves to each other that we will not buy or sell from this day for any person who whatsoever any kind of public stock at a less rate than 0.25% commission on the specie value, and that we will give a preference to each other in our negotiations. In testimony whereof we have set our hands the 17th day of May at New York, 1792. So, they made themselves an agreement. Sounds good though, but how do you get into being a stockbroker if you are not already one of those 24 super rich? So, by creating a closed, members-only financial marketplace, the Buttonwood Agreement set up the foundations of what would become the New York Stock Exchange. Although the exchange would not be formally organized and given a constitution for another quarter of a century, By 1793, the ranks of New York brokers had gotten too big to meet under buttonwood trees, and they made an elaborate coffee house, the Tonight Coffee House, their new center of operations. It's super crazy, Hewitt. Super crazy. The more I read, the crazier my eyes are like, what? More security industry growth followed the growth of the U.S., especially after. Stay tuned, Hewitt, because what's even crazier is when we look at the list of 24 brokers who signed the Buttonwood Agreement. It's coming. Stay tuned. So, in 1817, as New York began to surpass Philadelphia as the nation's financial center, the Buttonwood Group established some new, more elaborate guidelines and named the New York Stock and Exchange Board. So by the 1800s, now they have the New York Stock and Exchange Board. In 1863, the organization changed its name to the one it holds today, New York Stock Exchange. So, 1863, it sure was a long time ago. 1963, it'll be 200 years in 2063. So in 40 years, it's not that long. I'm 40 years. And to go along with this new title, it constructed its own building at 18 Broad Street. So it went from a buttonwood tree to a coffee house to its own building. After decades of occupying floors and other exchanges, it's still at that location today, now occupying the entire square block. So, now we get on to the signers of the Buttonwood Agreement. Remember what we said. It was 24 stockbrokers, or 24 of the most well-to-do, what did they use? Creme de la creme of New York. And so who was it? So 24 men signed: Leonard Bleecker, Hugh Smith, Armstrong, and Barnwell. And these are two different people. If you look up Armstrong, you look up Barnwell, they're two different people. Samuel March, Bernard Hart, Alexander Zuntz, Andrew D. Barclay, and we all know the Barclay name, Sutton and Hardy, Benjamin Sixus, John Henry, John A. Hardenbrook, Samuel Beebe, Benjamin Winthrop, John Ferrers, and Ephraim Hart. So, we can look up, we know that Ephraim Hart is a merchant organizing, he has his own Wikipedia, so you can look this up. He was a prospering Jewish, he came from a prospering Jewish community in Bavaria, Germany. And he came to Philly. That was where the original, they said that was the original merchants. And he was a merchant in Philly. And so he was on a list in 1799 of a list of owners of houses and lots valued at $2,000 or more. So all of these people on the Buttonwood Agreement, they were on that same list. So all of these people owned property and houses of at least $2,000 and more. And that's why they were signing this agreement, because they owned property, they owned stock and mutuals and bonds, and they didn't want to lose out. So they made this deal. So we also have, who else has a Wikipedia? Anthony Lispinard Bleecker was a prominent banker, merchant, and auctioneer, and one of the richest men in New York. He worked as well as a vestryman. What's that? What's a vestryman? A member of his local church vestry or leading body. Okay, guys. So last night reading about this stuff, most of these guys had something to do with being a member of the clergy or this type of a committee for secular government. A lot of them were Jewish merchants, like the last one, or this guy worked as a vestryman for the Trinity Church and in Lower Manhattan. If you look at the Trinity Church, I want to say, I can't remember who exactly, but I was reading about, they also worked at the Trinity Church. We have John Bush on here. Everybody know the Bush name. I'm sure it's the same Bushes. Who else? Some of these people, the last names changed. Like, for instance, Barclay didn't. Barclay's a well-known last name. Like Barclay Banks. He doesn't have his own Wikipedia, though. But yes. So as we can see, all the signers, we weren't, denying it. They were all very famous people, or not famous people, very rich people. They were very well connected in the community and the church. And they had a lot of property, at least $2,000. This was in 1799. 1799, what was it? $2,000 was worth what? The conversion rate? What would inflation rate be? Huh? Oh, wow. He was way ahead of me. He says that 2K is 63 bands in today's money. So they had $63,000 worth of property in 1799. So I wonder how much a piece of property, like let's say if you live in a 2-bedroom home with 2 baths and you live in a little hut. I don't know what they were called back then, not huts. But in 1799, whatever the houses were called, some of them were called shotgun houses. Let's say you lived in a shotgun house. How much did a shotgun house cost? $100? $50? I don't know. But how much property must they have owned if they had owned $63,000 in property way back in 1799? That's crazy, guys, because exactly, Hewitt. Inflation is not the only factor. So what is the exchange rate for how much property they owned in New York in 1799? It was a lot because these guys they signed this and they made they're the founding fathers of this, and it's still here. It's still here. It'll be here until it's not here anymore, and they made it. So of course they were rich. So that is the crazy Buttonwood Agreement history of the New York Stock Exchange. It was originally the Buttonwood Agreement. Let me know in the comments if you find out anything radically awesome about any of this that I haven't said. I'm very interested. Like I said, I'm just trying to learn all of this from the bottom up. So we know what the stock exchange is. Hewitt says these guys destroy inflation with their profit margins. Inflation was probably the least value that got from those investments. Exactly. Because they also control, from what I don't know a lot about it, but if you look at how they grow their money, I mean, you're kind of playing a board game with them that they're guaranteed to win. Like, these guys made the board game. They made up the rules for the board game. They have their original pieces from the original board game. Then they get to still play with them. So, I mean, it's like comedy to think anything other than that. Like, inflation, the growth of the price wasn't anything. It wasn't it. It was the growing of the money over time. Like, inflation was just a side effect of the money they were creating. And we can see that because the money that was available in 1799 versus the money that is available now, and where did it come from? It came from banks. And where did these banks come from? Wall Street. So, I mean, so kind of an all big fat circle that leads right back to these 24 guys and their original extreme wealth. So, we know what the stock market is. We know what a stock is. And we know who started the stock market. Why would they want to start the stock market? What would be the benefit of buying a stock or offering stock to individuals? Where is... We got lost, guys. We got lost, but that's okay. So, what makes the stock market work? Money, right, guys? We know that these stock market is made by the selling and trading of shares of equity of companies, and these companies increase the stocks to increase money and capital. And so that's what you're doing. You're buying a piece of the equity in the company, and they can increase that. So if they have 1 million shares, they can increase that to 2 million shares by increasing their equity and selling the stocks. As long as they can prove the equity of the company is worth, the capital of the company is worth, they can increase their stocks. So you buy stocks, they look like they have a lot of people interested, their capital increases, and then they can give you more stocks or have more stocks up for sale. People can buy more stocks, you can sell more stocks, hence making more money. Money that didn't exist before. It wasn't, you're not taking money from somebody's pocket and giving it to these other people. It's you're increasing your capital on your business by saying that all of these people are interested by selling lots of shares. But we know who's involved in the stock market is mostly the super uber rich. And that's not representative of our country. So if the super uber rich buy a bunch of stuff because they want a stock to soar or they want a company to look better, they can invest heavily into it, making the stock appear to be something we all want when really it's not. It's something that kills you. I don't know, some horrible food that has pesticides in it. But because it looks like it's popular, people will buy it. It may go out of business eventually, but they've already made the money. The capital is already there. The company already created that amount of money. Somebody bought those stocks and that money went into their accounts. So the company goes bankrupt, but all of these people that come from these 24 people that first signed this agreement, they're richer. If you look, I was explaining yesterday, if you put your money, even if you just put $1,000 in, 10% a year, guys, it's on average that it increases. These people have proven this. It's not gambling. It's the stock market. Rich people put their money in the stock market. They invest in the stock market because it is profitable. If it wasn't profitable, they would have stopped this a long time ago. There's no way that the Buttonwood Agreement would have continued. They would have kept ripping people off until they burnt it out. And once it was burnt out, they would have come up with a new scam. But by operating under their laws and rules and having people regulate it like the SEC that we learned yesterday, then they can control the entire business, making it not a scam, making it not faulty. They legitimized it. So that is why people should understand the stock market. Maybe you don't have the gall, whatever you call it, the guts to risk, because the stock market includes a lot of risk management. I understand that, but everybody should be educated about the stock market. Everybody. And not because it affects the economy. We learned that yesterday. Not just because of that. The stock market, it's because it affects you. If rich people, uber wealthy, what do they call them? The creme de la creme. If they decide everything in our country, they decide everything for you. And you're not rich. I'm not rich. Most of us are not rich. So understanding how this works is dire, but we don't do it. We don't teach this to our children. How many children in high school know about the stock market? I didn't learn about the stock market in high school. I didn't learn about the difference between stocks and bonds. I learned basic accounting because we had to write checks in one of my IT classes. But that was it. That was my extent of go out into the world. And how many checks have I written as an adult? You guys want to know? I've written 3 checks. Way back when checks were checks, and that was before debit cards and the internet. I wrote 3 checks. I took a whole class on how to write checks, and I wrote 3 checks in my whole life. That's it. 3 checks. So I've seen these people my entire 40 years. The descendants of those same 24 people and many more that have been added along the way. Why they had to get a new stock market location instead of trading under a button tree. They allowed new people in. So it's grown. The amount of rich people of uber wealthy creme de la creme has grown. So if it can grow, then I can grow, and it's been going strong for the whole 40 years I've been alive. So I think all of those are perfect reasons of why we should all, every single one of us, including your children, if you are teaching your children about money, they should know about the stock market. They should understand the basics. There are too many tools online we talked about yesterday. There's simulators. If you don't understand it and you can't explain money to your child, there's a million places online that will help you explain it. It's okay. It's okay to say you don't understand something, and it's okay to learn something new. And if we all did that, probably be a little better off in this country. So what is the difference between us? Where we got all lost on this buttonwood. Everything's buttonwood. They were so interesting. I just couldn't stop. I couldn't stop Googling buttonwood, guys. I would like to dig a little deeper and see who the descendants of some of those, of the people were, because I know the Barclays are still around. I've seen like Barclay Bank and a lot of Barclay stuff. I think there's like some type of machining company that's Barclay. I see it a lot. But where is bonds? We know stocks. Well, let's pop over there to stocks first and get a refresher. What is a stock, guys? What did we learn? Oh, this is just best valued stocks. So what is a stock? What is a stock? Come on, pop it up. A common stock is a security that represents ownership in a corporation. Basic, guys. Basic stock, right? That's what we learned. It gives you a piece of the pie. So, now, what is a bond? So we know that also gives us the right to vote if they're allowed to vote. Buying a share. A stock allows you to have derivatives if they have derivatives, which, remember, we learned what derivatives are. They are payments made usually quarterly or yearly in cash or other stocks for how well the stock did. We learned that yesterday. If you want to go over it a little bit more, we will later. If you want to just get the basics, go back to yesterday and check it out, or just Google what is a derivative. So, a dividend. I'm sorry, guys, I used the wrong word. I meant dividend. Wrong word. And a bond. That was today's, guys. We wanted to learn what was the difference between a bond and a stock. Are they the same thing, or can they be used interchangeably? Let's see. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. So, excuse me. Got a dry throat from talking. Okay. So, a bond is a loan. That word right there, immediately, loan, stuck out to me because it's not. A loan, it does not mean you own a piece of the equity. So a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond can be thought of as an IOU between the lender and the borrower that includes the details of the loan and its payments. So you go to your mom and you say, Mom, can I borrow $200? I'll pay you back next Friday. This is what that is, but they write it down. Got it. IOU. That's what a bond is. That is not what a stock is. A share of a stock is you invest and you buy a piece of the pie, right? So look at that, guys. In what? 13 seconds, we told the difference between what a stock and a bond is. This is easy, guys. This is easier than you think. You just got to break it down in a way that makes understand to you. If I could talk, we could probably all understand better, but you have to break it down in a way that makes sense to you. And there's like, I've been flipping through so many of these. There's so many things on the internet that will help you to learn however you need to learn. Do you just like to watch videos? There's a million of them. Go to Khan Academy, like I suggested. Uni or Yumi, I don't know what that's called. I haven't used that one personally. But I know people that buy courses on there and they give it 2 thumbs up. But let's go. So we know what a bond is. Bond details include the end of the date when the principal of the loan is due. So if mom told you Friday, that would be the principal is the amount of the loan. So we know, we're just learning these words, guys. Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually include the terms for variable or fixed interest payments made by the borrower. So, interest is on bonds, guys, and we do not have interest on shares, right? If we buy a share of stocks, we do not have interest. So, there's another difference between stocks versus bonds. So let's get our key takeaway. Bonds are units of corporate debt issued by companies and securitized as tradable assets. A bond is referred to as a fixed income instrument since bonds traditionally paid a fixed interest rate, coupon, to debt holders. Variable or floating interest rates are also now quite common. Variable rates, that's what got us in trouble in 2008. They changed the rates on the housing. Rates went up. People lost their shirts. They lost all their shirts. They lost their dressers to put their shirts in, and the houses and the doors to contain their dressers. Variable rates, guys. Be careful. If you have credit cards, learn. Just go. Google what. You guys, look how easy it is. We read a word. Say you don't know what a variable interest is. Look at that. You see how easy that was? Investopedia says, okay, you don't know what a variable interest rate is? Here's the definitions, the pros and cons versus a fixed. How great is that? We will go over this. This coming week, we will go over variable interest rate versus a fixed interest rate. We'll go over the pros and the cons because obviously these things exist. These money mega mans, these creme de la creme, they make these things because they can make money off of them, which means you can too. There's no rules that say only the creme de la creme can make money off of any of these tools. So don't let me sour you towards anything. Don't let me give you any advice. Any financial advice. I'm going to give you advice right now. My advice to you is learn. Learn stuff. Learn anything. Doesn't matter. You start to learn something, you're going to want to learn something else. It's like a bug. It's like a contagion. You get it, and then you'll want to learn more. So just learn something. Maybe all you have to learn is how to whistle. Once you learn to whistle, you're going to want to learn to whistle a song. You're going to have to learn the song. Once you can whistle a song, I bet you'll be whistling all the time. I'm just saying, if you learn a little bit about money, you start to make a little bit of money, you might be more interested in making more money. And then, who knows, before you know it, you'll have invested so smartly and learned so much that you'll be a creme de la creme with the 24 buttonwood signers. And if not, you'll be smarter. It's a win-win-win-win-win. Maybe your kid will pick up something, or a friend of yours will pick up something, and they'll use it, and they'll become the creme de la creme, and you can sit back and get rich off of what they learned. Who knows? You might get lucky. You know, some people in life, they have all the luck. So, we know what the stock market is, guys. We know what a stock is. We know what a bond is. We know why they made the stock market. Creme de la creme, watching out for their money. And that's about all that we know right now. We're not very knowledgeable on the subject, but it's okay. We're going to get there. One day at a time. And I will see you guys back tomorrow. No homework tonight because it is a weekend. No promises on me being here on the weekends because learning on the weekends is difficult sometimes. You got to give it to me, guys. Sometimes when it's the weekend, it's hard to learn, but that's okay. We're going to do this. You come back, learn some more with me, teach me something, learn a nugget of information, and pass it on to a friend. Who knows? Who knows what will happen in your life? Sometimes nuggets of information provide you with benefits you couldn't ever imagine in your wildest dreams. Anyway, that's what I'm going to leave you with today, neighbors. Have a great day, and I will see you next time. Be there or be square. Bye, neighbors.